Picture this. You're sitting across from a billionaire who lost everything, then made it all back again. What would they tell you about money that school never taught you? I spent months diving deep into Morgan Housel's groundbreaking book, The Psychology of Money, and what I discovered completely shattered everything I thought I knew about wealth, success, and financial security. Today, I'm sharing the 20 most powerful lessons that didn't just change how I think about money, they changed how I live my entire life. But here's the thing that'll blow your mind. Most of these lessons have absolutely nothing to do with math, budgets, or investment strategies. They're about human psychology, and that's exactly why most people get money completely wrong. Stick around because by the end of this video, you'll understand why your broke uncle who plays the lottery might actually be making a rational decision, and why the richest person you know might be living in constant fear. Let me start with lesson number 1. And this one hit me like a freight train. Your personal experiences with money make up maybe 0.01% of what's happened in the world, but maybe 80% of how you think the world works. Think about that for a second. If you grew up during the Great Depression, you probably viewed debt as terrifying and cash as king. If you came of age during the dot-com boom, you might see rapid wealth creation as normal. If you lived through 2008, you might be skeptical of real estate forever. I realized this when I was arguing with my grandfather about investing in stocks. He kept saying they were too risky and I couldn't understand why. Then I learned he watched his father lose everything in 1929. His entire worldview about money was shaped by one event that happened before he was even born. Meanwhile, I grew up during the longest bull market in history, so of course I thought stocks always go up. We weren't looking at the same data, we were looking at completely different movies. This leads us to lesson 2. No one is crazy with money. Every financial decision makes sense to the person making it at that moment with the information they have and their unique background. That person buying lottery tickets isn't stupid. They might be someone who's never had a realistic shot at wealth through traditional means, so a 1 in 300 million chance feels better than a 0% chance. The person keeping all their money in savings accounts isn't being foolish. They might value sleep at night more than maximizing returns. Once I understood this, I stopped judging other people's money decisions and started trying to understand them. More importantly, I started questioning my own assumptions about what's rational with money. Lesson 3 completely changed how I view success. Doing well with money has little to do with how smart you are and a lot to do with how you behave. You can be a rocket scientist and still go broke if you can't control your emotions. You can have a high school education and become wealthy if you have discipline and patience. The most important financial skill isn't taught in any economics class. It's the ability to change your mind when the facts change, to control fear and greed, and to make decisions based on long-term thinking rather than short-term emotions. I know brilliant people who day trade their way to bankruptcy and simple people who consistently invest in index funds and retire millionaires. Intelligence helps, but behavior trumps intelligence every single time. Here's lesson 4, and this one might make you uncomfortable. Soft skills are way more important than technical knowledge. You can know everything about price-to-earnings ratios and compound interest, but if you panic and sell during market crashes, that knowledge is worthless. The person who knows nothing about finance but has the emotional fortitude to buy and hold through volatility will outperform the genius who gets scared and makes emotional decisions. This is why so many financial advisors focus more on psychology than mathematics. They know their biggest job isn't picking the perfect investment, it's keeping their clients from making catastrophic emotional mistakes. Lesson 5 will change how you think about planning. Things that have never happened before happen all the time. History rhymes but doesn't repeat. The most important events in economic history, the Great Depression, World War II, the invention of the internet, the 2008 financial crisis, the COVID pandemic, were all surprises that couldn't be predicted by studying previous patterns. This means your financial plan needs to account for the unaccountable. You can't just look at historical returns and assume the future will be similar. You need to build in margins of safety for things you can't even imagine happening. The best financial plans aren't the most optimistic ones, they're the ones that can survive the impossible. Lesson 6 is about the most underrated financial skill, getting the goalpost to stop moving. We live in a world where there's always someone richer, always a bigger house to buy, always a more expensive car to drive. Social comparison is the enemy of financial satisfaction. You'll never have enough money if you're constantly comparing yourself to people who have more. I used to think I needed $1 million to feel financially secure. Then I met people with 10 million who felt broke because they hung around billionaires. The goalpost kept moving and no amount of money could catch it. True wealth isn't about having more money than you need. It's about needing less money than you have. This brings us to lesson 7. You'll change your mind about money throughout your life, and that's perfectly normal. The career you want at 22 is different from the career you want at 45. The house you want when you're single is different from the house you want with 3 kids. Your risk tolerance changes with age, experience, and life circumstances. The mistake is assuming your current desires and goals will remain constant forever. Build flexibility into your financial plans. Don't lock yourself into decisions that can't be changed when your priorities inevitably shift. Lesson 8 hits different. Nothing is as good or as bad as it seems. When markets are soaring, it feels like they'll never come down. When they're crashing, it feels like they'll never recover. Both feelings are wrong. Extreme outcomes tend to be followed by moves back toward the average. The key is remembering this when emotions are running high and making decisions based on long-term probabilities rather than short-term feelings. I learned this lesson the hard way during the COVID crash. When everything was falling apart, it felt like the world was ending and I'd never recover my losses. 6 months later, I was kicking myself for not buying more when prices were low. Our brains aren't wired to think probabilistically, they're wired to assume current trends will continue forever. Here's lesson 9, and it's a game changer. Identify the game you're playing and make sure you're not playing someone else's game. Day traders and long-term investors are playing completely different games with different rules, time frames, and definitions of success. The problem comes when you try to use day trading strategies as a long-term investor or vice versa. Figure out what game you're playing. Are you investing for retirement in 30 years or trying to make quick profits? Are you building generational wealth or saving for a house down payment? Once you know your game, ignore the noise from people playing different games with different goals. Lesson 10 is profound. Respect the mess. There's no single right way to manage money because everyone's situation is different. Personal finance is personal. What works for your friend might be terrible for you. What worked for your parents might not work in today's economy. Embrace the complexity instead of looking for simple formulas that apply to everyone. This was liberating for me. I stopped trying to follow cookie-cutter advice and started building a financial approach that fit my specific circumstances, goals, and personality. Your mess is unique and your solutions should be too. Lesson 11 changed how I think about time. Use money to buy time, not things. The highest return on investment might not be from stocks or real estate. It might be from buying back your time so you can focus on what really matters. So this could mean hiring a cleaning service so you can spend more time with family, or choosing a job with a shorter commute even if it pays slightly less. Time is the only resource you can't get more of. Money can often buy you more time, and that trade is usually worth making. Here's lesson 12. Save money because you want to, not because you have to. Saving motivated by fear or obligation rarely lasts. Saving motivated by freedom and opportunity is sustainable. Reframe saving from sacrificing for the future to buying options for the future. Every dollar saved is a dollar of freedom, a dollar of opportunity, a dollar that lets you say no to things you don't want to do. When I shifted my mindset from I have to save to I get to save, everything changed. Saving became empowering instead of restricting. Lesson 13 is counterintuitive. Define enough and stick to it. In a world of infinite options and endless social media comparisons, enough becomes a moving target. But without defining enough, you'll never feel wealthy no matter how much money you have. Enough isn't about the number in your bank account. It's about the relationship between your income and your needs. Write down what enough looks like for you, not what enough looks like for society, your family, or your social media feed, what it looks like for you, and then protect that definition fiercely. Lesson 14 will surprise you. The person who can stay invested the longest usually wins. It's not about timing the market perfectly or picking the best stocks. It's about having the emotional and financial capacity to stay invested through multiple cycles of ups and downs. The magic isn't in finding the perfect investment, it's in not screwing up the good investment you already have. This means building your investment strategy around your ability to stick with it rather than optimizing for maximum theoretical returns. A good plan you can follow is better than a perfect plan you'll abandon. Here's lesson 15. Beware of financial advice from people playing with house money. Someone who inherited wealth or got lucky with a single investment might have very different risk tolerance and decision-making processes than someone building wealth from scratch. Their strategies might work for them, but be completely inappropriate for your situation. Always consider the source of financial advice and whether that person's circumstances are similar enough to yours for their advice to be relevant. Lesson 16 is liberating. You don't have to be an expert at everything. You don't need to understand every aspect of finance to build wealth. You need to understand the basics well and avoid major mistakes. Focus on getting a few simple things right rather than trying to optimize every detail. Most successful investors use incredibly simple strategies executed consistently over long periods. Complexity is often the enemy of good results. Lesson 17 changed my perspective on luck. Acknowledge the role of luck in success while controlling what you can control. Every successful person benefited from some combination of luck. Being born in the right country, meeting the right people, living during prosperous times. Acknowledging this doesn't diminish your achievements, it keeps you humble and reminds you to help others who haven't been as fortunate. At the same time, don't use lack of luck as an excuse for inaction. Control what you can control. Your savings rate, your skills, your network, your attitude. Here's lesson 18. Room for error is the most important part of any financial plan. Don't plan for everything to go perfectly because it won't. Build buffers into every aspect of your financial life. Save more than you think you need. Invest more conservatively than optimal models suggest. Keep more cash than feels efficient. These safety margins might seem like they're costing you money in the short term, but they keep you in the game when unexpected events happen. And unexpected events always happen. Lesson 19 is about compounding. Time is your most powerful wealth-building tool. Starting early matters more than starting with a lot of money. A 25-year-old who invests $200 per month will likely have more money at retirement than a 35-year-old who invests $400 per month, even though the 35-year-old invests twice as much money. This isn't just about investing, it applies to skills, relationships, and reputation. Everything compounds over time, and the earlier you start, the more dramatic the results. Finally, lesson 20 ties everything together. Wealth is what you don't spend. True wealth isn't your income or your possessions, it's your savings rate and your financial freedom. The person making $50,000 who saves $15,000 is wealthier than the person making $200,000 who saves nothing. Wealth is the money you don't see, the car's not purchased, the clothes not bought, the vacations not taken. This doesn't mean living like a hermit, it means being intentional about your spending and recognizing that every purchase is a trade-off with future freedom. These 20 lessons completely transformed my relationship with money. I stopped trying to get rich quick and started focusing on getting rich slowly. I stopped comparing my financial situation to others and started focusing on what enough looks like for me. I stopped making emotional financial decisions and started making behavioral changes that compound over time. The most important thing I learned is that money is ultimately a tool for living the life you want. It's not about having the most money, it's about having enough money to do what matters to you. Whether that's providing for your family, pursuing your passions, helping others, or simply having the freedom to make choices based on what you want rather than what you need. Your relationship with money is one of the most important relationships in your life. These lessons helped me build a healthier, more sustainable approach to wealth that served me well through market crashes, career changes, and life transitions. They're not just about money, they're about psychology, behavior, and building a life that aligns with your values. What surprised me most about studying the psychology of money is how little it has to do with money itself and how much it has to do with understanding yourself, your motivations, and your goals. The math of money is simple. It's the psychology that's complex. If these lessons resonated with you, I'd love to hear which one hit you the hardest in the comments below. And if you want more content about building wealth through psychology and behavior, rather than just tactics and strategies, make sure to subscribe and hit that notification bell. Trust me, understanding these psychological principles will do more for your financial future than memorizing any formula or following any guru's specific investment advice.